Telstra Group Limited, an Australian telecommunication company, recently unveiled a $1.6 billion project to enhance the national fibre network. The initiative, announced in February 2022, aims to deploy 20,000 kilometers of inner-city low-latency fibre path, drastically improving transmission rate to 650 gigabytes. This strategy move responds to the growing demand for faster networks across various sectors and hope to successfully deploy them by 2027.
The project's benefits are primarily divided into revenue and salvage value. Telstra has announced in the market release section that the annual revenue estimate for the project is $200 million. The salvage values are approximately $126 million for Alternative A and $121 million for Alternative B, indicating no significant difference. Based on specific economic models, roughly 60% of the initial investment should be sourced from borrowed funds to optimize the project's cash flow structure. In concrete terms, the value for Alternative A amounts to $600 million, whereas Alternative B stands at $576 million.
Moving forward for project costs, the capital investment for Alternative A is $1 billion based on Telstra's announcement. Alternative B is slightly less at $960 million, which was based on profit per 1 kilometer of fiber installed aerially. Under the operating cost, A's costs are largely fixed as Telstra has established several contracts per project execution. Overhead, manufacturing, and maintenance expenses are predetermined and consistent for both alternatives, hence they are classified fixed. However, there are notable variances in operating costs between two options. For A, we're looking at maintenance costs of $350 million derived from contractual obligations with several companies. This is significantly higher than B's that has only $3.2 million. However, B incurs labor costs of $360 million due to the intricate demands of aerial operations. It is important to note that the Alternative B's labor cost, unlike A's fixed maintenance outlay, is variable and may fluctuate based on project specifics. Classification of costs reflects the one-time investment nature and service-oriented framework of the projects. In summary, while Alternative A offers cost stability via fixed contracts, Alternative B presents potential variability in labor expenses. This requires careful consideration to align with our financial strategy and operational goals. Turning on our attention to the operating activities on the left, Alternative A, with its $1 billion capital investment, starts with a lower net income. This is due to a higher calculated initial depreciation. Meanwhile, Alternative B has an initial higher net income due to a lower depreciation. Now let's shift focus to the investing activities on the right. Alternative B has a salvage value of $465 million, while A has $484.4 million, suggesting an efficient preservation of asset value. The losses on depreciable assets for Alternative B is marginally below Alternative A's, which aligns with less aggressive depreciation approach seen in the operating activities. Lastly, Alternative A allocates slightly greater funds to support day-to-day operations. While both options use double declining depreciation method, A is more aggressive with higher initial cost and salvage value, while B provides steadier income and slightly better salvage value, which indicates a more conservative approach. Moving on to financing activities, both projects borrowed 60% of the total capital investment. Alternative A borrowed $600 million with $60 million repayment for 10 years, while B borrows less at $576 million with $57.6 million annual repayments. On the project cash flow, both alternatives start with a steep negative cash flow reflecting heavy initial investment. They recover quickly to a positive cash flow by end of year 2, indicating that the investments begin to pay off. Through most of the project lifespan, the net cash flow of both alternatives increases steadily. Around year 30, Alternative B's net cash flow surges markedly, ending the period with a much higher cash flow compared to Alternative A. This suggests that while Alternative A may require higher borrowing and repayment, Alternative B ultimately provides a greater return towards the end of the project's life.
The underground optic fiber installation project manifested a payback period of 8 years, indicating a long period of profits. In contrast, the area project with a considerably shorter payback period of 4.8 years present a more favorable route to recovering the initial investment. Moving to the realm of net present value (NPV), a metric that encapsulates an investment value in present terms, the underground project commands a robust NPV of $220 million. This figure shows a promising profitability trajectory. In comparison, the area project NPV is slightly lower at $211 million, still demonstrating a commendable positive value. While both project promises profitability, the underground option marginally outperformed its area counterpart in terms of present value. Considering the benefit-cost ratio and metric pivotal engaging investment profitability, both projects shows promising ratio above 1, indicating a potentially lucrative investment. The underground optic fiber installation project boasts a benefit-cost ratio of 1.45, implying a return of 1.45 for every dollar invested. Conversely, the area project outshines with a higher benefit-cost ratio of 2.28, underscoring its superior potential for profitability comparing to the underground alternative. Lastly, the internal rate of return, IRR, a crucial metric reflecting an investment profitability, illuminate a nuanced perspective. The underground method presents an IRR of 8%, signifying a modest yet steady return rate of investment. In contrast, the area method offers a slightly higher IRR of 13%, indicating not only a swifter return but also a heightened overall profitability compared to the underground option.
Effective risk analysis and management is a fundamental technique that helps anticipate, assess, and address potential challenges that could impact a project's success. We have conducted qualitative as well as quantitative analysis in order to gain further insight into the viability of Telstra's fiber project. Through qualitative analysis, we identified 7 main areas that could pose a risk to a fiber project such as Telstra's. These areas have been categorized within a risk matrix for both alternatives as shown. It can be observed that both projects have similarity in the threat of supply chain risks, technological risks, and regulatory risks. This is largely due to both alternatives having an identical supply chain as well as technologies used for the most part. Hence, both projects incur the same risk from these factors. However, there's a large difference in the severity of operational and quality risks between the alternatives. This is due to the fact that laying cables underground is significantly more logistically challenging in comparison to aerial placement, which increases the chances of project delays and resource shortages. Quality and performance risks, however, are much greater for aerial construction because it is more prone to outages due to weather or environment. The quantitative risk analysis measures risks in a numerical manner. A sensitivity analysis was performed on both alternatives of Telstra's fiber project. We discovered that revenue is the most critical factor that determines the viability of the project. The graph depicts that NPV changes dramatically even with a slight difference in revenue. Therefore, it is vital for Telstra to ensure that they maximize the benefits with the new fiber installation. Furthermore, both alternatives are remarkably sensitive to changes in discount rate as well as inflation rate. This means that it is important for Telstra to negotiate a feasible discount rate when borrowing cash for this project. A notable difference in the sensitivity analysis of the project is that Alternative A is more sensitive to maintenance cost changes in comparison to Alternative B. This may be because of the higher maintenance effort of cables laid underground compared to aerially placed cables on existing telephone poles.
We recommend adopting aerial installation over underground installation. This choice significantly reduces maintenance expenses. leading to higher net income and a quicker payback period of 4.8 years, addressing Telstra's previous financial challenges effectively. Alternative B demonstrates superior financial metrics, including an outstanding NPV of $2.7 billion, a strong BCR of 2.33, and an excellent IRR of 22%, outperforming Alternative A. Additionally, Alternative B is less sensitive to changes in maintenance costs, indicating lower maintenance pressure. Telstra can leverage existing infrastructure to explore specific routes for aerial installation. To improve future analysis, precise project information from Telstra and advanced economic models would ensure a more accurate alignment with real-world situations.